Our final component of budgeting is going to be about financial budgets. These are basically going to include the balance sheet. We're going to look at and investing activities. And investing activities have to do with capital expenditures. When you actually buy large pieces of equipment, you are actually investing in your business so that you can continue to make more and more profit. So the two budgets under the financial are called the cash budget and the capital expenditures. So just to clarify, the cash budget is going to say, hey, we're going to have two separate budgets underneath that. We're going to look at all the money we're going to get, and we're going to get money from sales, and it's going to look at when the timing of it is important. And then we're going to examine all the money we have to spend, which is basically our expenses for our direct materials, our direct labor, and our factory overhead that we pay out. So we're looking at basically the inflows and outflows of cash for our system. We're going to start with our cash receipts. This is probably one of the more difficult ones, is that we get our money from, say, cash sales and collections on account. So most of the time we're going to be looking at money coming in from accounts receivable, and the timing of it is the most important part. So again, we always look at this at a 3-month period. So we're going to be looking at January, February, March. Here are my budgeted sales. And here's my accounts receivable starting at the beginning of January. So this accounts receivable would have actually been from December sales. So here's how I get my money. From the prior month sales on account, I get 40%. From the current month sales on account, I get 60%. So what that means, in January, if this is my sales, hold on, let me put my laser up here, my pointer. Okay, if this is our January sales, 60% of that money will be received in the month of January, and 40% will be received in the month of February. So given that, this 480,000 represents 40% of December sales. So we're going to have this little spreadsheet, and I want you to pay attention to it, okay? So February and March, and here's what it's going to look like. It's a little complicated. We're actually only looking at February's receipts right now. So here's my budgeted sales for January. So we're only looking at 1 month. Usually you will do 3 months. January, I get my sales are 1,080,000. 40% of that will be received in February. So February, I'm going to get this much money. February sales, 60% of the sales will be received in February. So I get this much money. So my receipts for the month of February will equal this much here. So in a minute, I'm going to show you the next slide, which has all 3 months. So here we have, so this is the 400 for January. Okay, so here's our February number. I'm sorry, I got a little confused here. Here's our February number we're receiving. So our January number will make up for our beginning AR balance because it would have reflected 40% of December sales. This is 60% of January sales. So here's the total money I will receive in January. Here's the total money I will receive in February. March. So this number here represents 40% of February sales and 60% of March's sales. And here's the total amount. So here's my little notes down here. This is kind of confusing. So this is how much money I will be receiving for each of these 3 months. Now we're going to stop and look at how much will I expect to pay out in those 3 months. This is called schedule of collections from sales. Next, we're going to look at estimated cash payments. Okay, so I pay out for cash. I pay for my direct materials. I pay my direct labor. And then often, sometimes I will have to pay factory overhead bills. So here's my data. Here's my January information, my February, my March. So here are my manufacturing costs. These include direct materials and any factory overhead involved. Okay. Depreciation on machines. These are my costs for depreciation. Now, I'm going to ask you, do you remember what kind of cost is a depreciation? Hopefully you get this right. I told you in 1A multiple times, depreciation is a non-cash expense. So I'm not actually putting money out for this, but I will use it as a reduction on my taxes. Okay, so here's my accounts, my direct material, my direct labor, and my factory overhead bills. My accounts payable at the beginning of the year, and how I pay my accounts payable. So whatever my manufacturing costs are, 25% is going to be paid from the previous month. What that means is in January, I will be paying 25% of December's. In February, I will be paying 25% of January's. Current month is 75%. So current month of manufacturing costs will be paid out in that month. So we're going to look at February only on the next slide. This is a little confusing. I'm only looking at February. First thing I do is subtract the depreciation because it is a non-cash expense. So here's my January manufacturing cost. Here's my February manufacturing cost. So for February, 25% of January's will be paid out in February. 75% of February's will be paid out in February. So here's my total payments in February. So I'll say it again. 25% of the previous months will be paid in February. 75% of the current month will be paid in February for a total of this. So here is my schedule of payments of manufacturing costs. January, this represented the accounts payable balance given at the beginning of the month, or the year, I'm sorry, which represents 25% of December's manufacturing costs. The 204 is 25% of January's manufacturing cost after I minus depreciation right here. And the 189 is 25% of February's. These represents 75% of January, 75% of February, 75% of March. So here's the payments I'm going to make. So now we know the money coming in, when it's coming in. We know the money going out, when it's going out. Our next slide is going to represent a formula that you absolutely must memorize and commit it to heart. How much money I'm getting minus how much money I'm spending will have an increase or decrease of my cash. Obviously, when I get more than I spend, I increase my cash. When I spend more than I get, I decrease my cash. I'm going to add that to the cash I had at the beginning of the month, which tells me how much I should have at the end of the month. Then I always, in manufacturing, you always need to keep what we call a minimum cash balance. I know in real world that is not happening for most of us. And so once I subtract that, I'll either have, the amount I'm going to have will either be excess or deficient. Okay? Now, in order to do a complete cash budget, which we haven't done yet, we need more information. Here we just know when we're getting money, how much we're getting, how much we're spending. Here's other information we need. Here's how much money I have at the beginning of the month. Here's my quarterly taxes that have to be paid at the end of March. Here's my interest expense that has to be paid in January. Here's interest revenue that I'm getting in March, so I'll be adding that. And I plan on buying a big piece of equipment in February. And here are my selling and admin expenses. So with this information, we're going to look at the cash budget. However, you cannot do the actual cash budget unless you know how much money you're getting and how much you're spending. So this first row here this is for January, February, March. So this tells me the money coming in, plus here I have the other revenue coming in. So this will be all the revenue coming in for each of the months. Here's the schedule of manufacturing costs. Here's the money that's coming from my selling and admin expense budget. And then I'm spending $274,000 for a new piece of equipment. I'm spending money for interest expense, and I'm paying taxes. So here's my total cash payments. Here's my total cash receipts. I'm going to subtract them. In this case, I have an increase. This case, I have a decrease for February. And March, I have an increase. Here's my cash at the beginning of January plus the 143,500 tells me how much cash I have at the end of the month. By the way, the minimum I want to keep is 340,000, so I subtract that, and now I have an excess of 28,500. So keep in mind, when I get down here, the cash balance at the end of January is going to be the cash balance at the beginning of February. And the end of February will be the beginning of March. So pay attention to this. This concept right here is difficult for many, but literally it tells you that at the end of March, here's what I'm going to have, 362,000, and I basically have 22,000 over what I want to keep in there, which is a good thing. In some instances, if I want to keep the 340,000 cash at all times available, and in February where I'm below, I would actually borrow the 5,500 to bring me up to the 340,000, which would mean that when I get to March, one of the first things I have to do is pay back the 5,500 plus interest. But this particular textbook doesn't show that, but in most instances in real world, that's what you're doing. So this is cash budget. It is one of the more difficult budgets because it's all about understanding this. Hopefully you understand how much money I'm going to receive, when I'm going to receive it, how much money I'm going to spend, when I'm going to spend it. So we're going to move to the capital expenditure budget. That has to do with when I need to buy new fixed assets. And I usually replace them every 5 to 10 years. It depends on my business. It depends on what I'm doing. But I actually have to put them in the budget so I can plan for them. So it's very simple. I already know that I'm going to be replacing equipment in these years. In the cutting department, I'm obviously buying new equipment this year. Next year, I'm not buying any. In cutting, I'm not buying again till 2019, 2020. But these are numbers that I can project because I do need to replace my equipment every so often. Now, if my equipment breaks down and I fix it, that is a repair expense and would not be in the budget. Okay? Most of us like to budget for a car, but some of us don't. We just go out and buy it when we decide we're not putting money into our old car anymore. So we would use the same concept on that. So capital expenditures budget, very simple, just a snapshot out for 5 years about what you're going to put out to buy equipment or to replace equipment. The last slide I'm going to talk about is the budget sheet. I'm sorry, the balance sheet, the budgeted balance sheet. Guys, sorry, this is not scripted, it's live. So I make mistakes, you know that. So I don't actually have an example of it, but I basically know all the components. I know my ending cash at the end of the year. I know my accounts receivable at the end of the year. I know the balance of my assets. I know what they're worth. I know my accounts payable. I know my retained earnings. I know all of that stuff. So once I do the cash budget, I can then complete a balance sheet. And this is called a pro forma balance sheet. It's a balance sheet before it actually happens. If you're in real life business and you're trying to borrow money, the bank will ask you for a pro forma. That's the word perform with the letter A at the end. It's called a pro forma income statement and a pro forma balance sheet. It's nothing more than a budgeted income statement, a budgeted balance sheet, which are the same things that we've gone over in this chapter. Remember, this is one of the easiest chapters. Enjoy it. It's not difficult. And when we move next week to chapter 22, remember that is the hardest chapter. And I will provide as much help as I can with you on that. Thank you.